as I was saying, as we even covered yesterday, we started on the capital markets and we discovered and we highlighted some of the functions of the capital markets. We highlighted some of the even the classifications of capital markets. In each, we even looked at an hypothetical sample of a price discovery and a capital raising function, especially in the primary markets. And then we also looked at secondary markets. And so now, today I wanted us to continue by looking at why would someone take this course, or basically why would someone take this course, or why would someone, especially somebody who's interested or is in the field of capital markets and investments, like you are in the retirement benefits in things, pension funds, things like fund management, mutual funds, things like that. Why would anyone be interested in such a course or in such concepts of capital markets and investment strategies? Or basically, what is the importance of capital markets or learning about capital markets or analyzing capital markets and investment strategy? So to a fund manager or to somebody who works in, let's say, mutual funds, or an investor, or to a potential investor, or to a potential actuarial analyst, capital markets and investments will help you to know how to, or to price, for example, the companies that you'd be interested in investing. What we call the process which we call price discovery. Even to the companies that are listed themselves, they can use capital markets and investment strategies to be able to help them during price discovery. You find that capital markets, it helps since there is the buying and selling of shares of listed companies, but that's usually based on for example, supply and demand, but also other market factors such as, for example, how customers view that company's performance and its general, for example, its general perception of that company, what we call investor perception or investor sentiment or market sentiment. Okay, so you find that capital markets will help such a company if a company or if an investor is interested in investing in capital markets. Okay, then they will use such strategies to be able to price or to discover the prices of the shares of the companies that they invest in. And to the companies, it will help them to gauge which prices they should price their shares at that price that is stable. Okay, because as we say, prices at the capital markets are based on a whole lot of factors, but majorly supply and demand, the supply and demand, and also the investor confidence or investor sentiment or perception of that company. And obviously also the company details like their performance, their earnings, their price per earnings ratio, their dividend payout, things like that, dividend prices. Okay, those are some of the factors that influence, for example, price discovery and the general investor confidence in the shares of a particular company. For example, let's say you are a company, let's say at Safaricom. Yeah, okay, Safaricom, the treasury manager at Safaricom wants to do a price discovery of Safaricom shares at the NSE. So you find that the share price of Safaricom will reflect, for example, how investors or how Kenyans generally perceive Safaricom. For example, Kenyans generally perceive Safaricom as that company that is very, very stable, one of the most stable companies to invest in its shares in, because of its innovation, because of its innovative products like M-Pesa, revolutionary products that they offer, like they just introduced what we call the standing order. They have their standing order, things like that. They are known to be very, very innovative. They also partner with companies, so even in the smartphone market, and in their, for example, in their retail market, and also in their telco business. So they are known to be very, very things like very, very innovative and very, very stable. So if a customer wants to invest in such as the Safaricom shares as opposed to, let's say, another company that's less innovative, okay, or that has a weaker market position, then you'll find that they'll prefer the shares of Safaricom, a company that's known to be innovative, and therefore the sentiment or the perception of such a company in the eyes or from the context of an investor is higher. Okay, but also not just its innovation. For example, also Safaricom has been known to make billions in profit after tax. Like the latest disclosure, did they make around over 50 billion or 40 billion? But it also, of course, was affected by the entry into Ethiopia. But still, just a minute. Yeah, but still, you find that the investor confidence is also based, or is also pegged on, for example, their recent financial performance and disclosures. Okay, when Safaricom announces, for example, a huge profit margin or profit increase, you find that the investor confidence in Safaricom increases. Therefore, the price of Safaricom shares will also increase accordingly. So that's one way of Safaricom guys doing price discovery using capital markets based on investor confidence in them, and also based on supply and demand of their shares, of course. Okay, but also there is another factor that also can affect price discovery in the capital markets, what we call market position or market share or market cap. You find that Safaricom is known to handle over, I don't know, well over 50% of the telco business in Kenya. M-Pesa is almost over 70% compared to Airtel Money, compared to other mobile money services and other banks. You find that almost everyone has M-Pesa, okay? So their market position in terms of even just that one product is very, very high. Therefore, or very, very large rather. Therefore, you find that their share prices will also reflect that position, and also therefore Safaricom can use such capital markets fundamentals based on supply and demand, based on the confidence that Kenyans have, and other investors, not just Kenyans, other even international investors have in Safaricom itself. Okay, for example, also another thing, when Safaricom announces a new product, okay, they just announced, their new MMF, ZED, okay? They also announced their new standing order business called Ratiba. You find that when they announce these new products, they are to know, like their share price will also be directly reflective of that, of such investor confidence in such such announcements, and also even in their results, and it will directly affect, in this case, increase their share prices at the Nairobi Stock Exchange. That doesn't apply to just Kenyan company. We can even go global. Even if we go to Apple, a company like Apple, you find that Apple is known, for example, to be very, very innovative. I mean, they upgrade their iOS and their Android versions. I mean, iOS versions. Apple 16 just got announced the other day. You find that, for example, after such an announcement is made, therefore their stock prices will increase. So in this way, capital markets will help them in their price discovery. You find that, for example, also Apple holds almost their market cap and market position, the market share that they hold, for example, in the smartphone market, for example, in just the USA, is much more than other competitors such as Samsung. Though worldwide that may be not true, because Samsung is worldwide holding the higher market share, okay, or market cap. Okay, their revenue, Apple is one of the big five, all right? Their revenue alone, you find that also boosts investor confidence, what we call investor sentiment or market sentiment regarding their stock price or share price. Okay, when let's say they plan on announcing the new iPhone 17, let's say they announce it next year, you find that after such a release or such a launching of a new product, their stock price will also be reflected on that. Let's also look at even another company like Tesla. You find that just like we were talking about it yesterday, you remember? When Tesla stock fluctuations and increase in this matter, in this case, was influenced by their last quarterly earnings was very, very good. Okay, their last quarterly earnings were their last quarter. In the last quarter, the earnings in the last quarter were very, very good. And therefore, you find that the market sentiment or the investor confidence in Tesla increased. But also even due to the political landscape in what happened in America, due to the CEO of Tesla being one of the winners of the US elections. Therefore, even the investor confidence in such a company increases. Also, there was a huge uptake of electric vehicles that Tesla majors in, especially in the EU, in the European Union. Therefore, investor confidence will increase in such a Tesla company, and therefore their stock prices will increase. For example, I will share notes with you with a direct link to even where to even track, for example, some of the share price and stock price trends and movements of some of these companies I'm talking about. But obviously, you can even also look at, there are a whole lot of places here, Bloomberg, bar chart. There are a whole lot you can check and you can see exactly what I'm talking about. Okay, but obviously, let's also look at the flip side. When we talk of a company that is now also not undergoing a very, very good market perception, then therefore, or maybe due to political tensions in a country or political changes in the country or in the environment they operate, then therefore that will also be reflected negatively or adversely in their stock prices. Okay. Let's also look at now the factors now that will influence in this case the movements of such or the fluctuations in the stock price. For example, as I said, just a quick recap, the quarterly earnings of a company. For example, if a company like Safaricom announces their last quarter earnings, their stock prices will and movements and trends will shift in a particular direction, reflective of what the earnings and announcements will be. Okay, when they announce, for example, a new technology or a new product launch. Okay, but there can also be even other microeconomic factors, for example, interest rates and for example, forex rates in the country that also affect some companies, especially those that are in the financial industry, banks and insurance companies, pensions. Okay. And also even just as I said, microeconomic, there could also be things like, for example, even in the environment, I mean, climate changes and cycles, climatic cycles. For example, a company that is focused on agricultural produce, for example, when they are when there are low agricultural produce or things like drought, things like that. Yeah, I hope you understand. Okay. Okay.
Yes, I'm here.
Okay. Yes. But don't worry, we'll have all the notes and we'll share all the notes and the recordings to these meetings. We can always even you can always get in touch for any questions you do. You have any time, even after the training has ended, and we will proceed in that same way. Okay. So let's say next, after now seeing how capital markets can be used, for example, by companies in their price discovery, share price discovery for that matter. Let's look at now, that was majorly in the primary. Let's also look at now a secondary market, for example. Okay, secondary markets is where we say is especially buying and selling or trading in shares of companies that are listed at the stock exchanges. Okay, there are even what we call virtual stock exchanges. There is one called Investopedia. You can even use that, for example, in your in your stock simulation to see how, for example, the shares of these companies will be affected due to, for example, the factors that that I just said regarding those that affect their share price discovery. Okay, so now I want us to look about to talk a little bit about. We are still on the concepts. We're still on the concepts in secondary markets, and one of the biggest concepts in secondary markets is also risk management. Okay, we have talked about secondary markets, stock exchanges. So now let's look at another concept under secondary markets, where we trade, buy, and sell stocks of companies that are listed at the stock exchanges. Therefore, trading and buying and selling of shares, an investor also need to do a little bit, not even a little bit, very, very thorough risk management. And I mean, due to the different financial risks that are involved in trading, for example, financial risk, forex risk, and also currency risk, okay, interest rate risk, things like that, then therefore we have very, very robust tools for risk management. We have futures contracts. You know what futures contracts are, option contracts, interest rate swaps or forex swaps, things like that. So swaps, futures, and such contracts can also be used during when an investor needs to do, for example, risk management when investing in a particular shares of a company at a stock exchange. But there is a whole just a whole lesson or module dedicated to that. We'll look at that in detail, but maybe to just provide a brief overview of what I'm trying to talk about. Futures contracts, you know what they are. A futures contract where you lock in a price, for example, the price of a share at a predetermined at a future date, so that you can buy it or you can sell it at a predetermined price in the future. Okay, they are basically contract agreements where two parties, let's say one who is selling a share and one is buying the share of that company, are locking a price that is at a predetermined price, so that they can exchange that at a future date. But we find that they're usually mostly used, especially in commodities trading, when even trading in such stable commodities like gold, oil. Okay, but they can also even be used in financial markets, especially in interest rate futures. We know interest rate futures trading. They are generally called derivatives, trading in derivatives. As I said, there is a whole lesson dedicated to that. We'll look at that in detail. For example, even examples how, for example, some companies that are listed, let's say KQ that is listed, wants to use futures, okay, to lock in maybe the prices of their share, okay, or they can even use the futures contracts to lock in the price of oil, of jet fuel that they use, okay. They can use futures contracts, okay. But we'll also see, while we'll be looking at that, we'll also be looking at the benefits and risks associated with each event type of hedging strategy or risk management strategy, okay. Next, now let's look at how then we can use we've talked about that. We've talked about risk management and the various risk management strategies, futures, options, swaps. But as I said, mostly futures is usually the one that's mostly used in financial markets and capital markets in general. But we'll also even look at how we can even look at, even apply the other risk management strategies, and also the risks that are associated with each. Now, thirdly, I want us to look at the third concept under capital markets. That is the role of capital markets. That is just displayed on your screen, as you can see, the role of capital markets in economic development. We find that capital markets, as we have said from the very, very beginning, it promotes economic growth by mobilizing savings, especially from investors who want to invest in the shares of such economy. But also it facilitates infrastructure development, okay? Where, for example, you find that the government can use capital markets, okay, to, let's say, by issuing treasury bills and bonds to undertake development projects. Okay, therefore, the capital markets will ensure efficient resource allocation, support corporate growth, especially when companies and corporates issue, corporate bonds. Therefore, it will enable them, for example, to grow, or they want to expand into a new market, or they want to launch a new product, or they want to pay their debt. So in that context, it will ensure corporate the growth of that company. Okay, but also governments use it as a means of, for example, staying liquid. Okay, it provides the government with funds for development projects, as I said, when government issue T-bills and T-bonds. Okay, as we said, so let's look at now some of the issues in the capital markets. As I just said, literally just did, and governments can issue T-bills and T-bonds. They're generally called sovereign bonds, especially when they want to raise funds for infrastructure, or when what we generally call public expenditure, okay, or infrastructure development, or some development project they want to undertake. They can issue treasury bills and bonds, what we call sovereign bonds. So you find that the bonds, as I said even yesterday, they are, according to the Kenyan law, for example, and in our context, they are usually needed to be used to finance, for example, infrastructure development, for example, building of roads, building for example, the SGR and the Nairobi Expressway. Okay, that's what Kenya used, the 10 billion bond, euro bond that they issued, didn't they? Now we'll look at an example just shortly. Okay, or Kenya also even sometimes, they just issued another bond to repay the bond that they the euro bond they issued another euro bond to repay the other euro bond that they took. Okay, you find that, so what are some of the characteristics of such government bonds? They're usually considered the low risk, the very, very safest forms of investment. Okay, not just, for example, the Kenyan treasury bills and bonds. Even other countries, for example, the US treasury bonds are considered one of the safest investments, because you find that they are commodity backed, and they are backed by the entire sovereign government, or the entire government or economy of a country. Okay, so it's very, 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 very hard for the entire economy of a country to collapse. So when the economy of a country is backing, okay, or the treasury of a country is backing the treasury bonds, that in that case they are considered to be very, very safe to invest in. So yes, so governments can issue corporate bonds. Also, corporations and companies can also issue bonds, what we call corporate bonds, especially when they want to raise funds. For example, they want to expand, or even they want to acquire another company, or even they want to pay some of their debt. They want to, for example, to innovate, to enter a new product, to launch a new product, okay, to research, things like that. And therefore, unlike government bonds, they are a little riskier, okay, if you compare to government bonds. But obviously, the higher the risk, the higher the reward. So they are usually thought to be and known to be offering higher interest rates compared to T-bills and T-bonds. For example, a company that recently issued and regularly issues corporate bonds, Apple, okay, is a global company. It regularly issues corporate bonds, especially when they want to buy back shares or pay dividends to their shareholders, or even to fund R&D, that is research and development. And since as I said before, Apple has a very, very strong credit rating. As I said, now in the issuance, you remember yesterday, as I said, in the issuance of corporate bonds, the credit rating of that company also will come into play. But now, since Apple has a very, very good and a strong market and investor sentiment, therefore you find that their bonds are very, very attractive to investors. Okay, but as I said, they carry a little bit of risk, especially in comparison to the other types of bonds. Then therefore, what are some of the now? Let's look at a few concepts on of bonds that are issued by either the government or by corporates. Okay, we, as I just said, even the interest rate is a factor in the issuance of both sovereign and corporate bonds. Okay, in bonds we call it coupon rate. Okay, which is basically the amount that the company now issuing the bond or the government agree to pay you, for example, in an annually, or it can even be semi-annually, or as a percentage. It's usually as a percentage of the face value. That's the value of the bond itself, the corporate of the treasury bond itself. And it's usually, how do we determine? It's usually determined by, for example, as I said, the risk profile of that issuer. Okay. For example, when companies that have a lower credit risk, as I said, for example, government, and have higher credit ratings, therefore they will offer lower interest rates, as I said even before, compared to companies that will issue bonds but will have to give a little bit higher interest rates. Okay. For example, you find the Kenyan Treasury bond, due to its low risk profile, will offer bonds with rates as low as let's say 15%. Okay. But a corporation, let's say Safaricom, okay, with which has obviously a little bit more credit risk associated with it, will have to part with a little bit of higher interest rates or coupon rate on the corporate bonds that they issue. But it's not just the risk profile of the issuer, in this case a corporate or a government, that determines the price or the coupon rate of a bond that they issue. It can also be determined by factors like for how long are they issuing that bond, or even other market conditions. For example, microeconomic factors in the economy, investor confidence in that economy. Okay, so such factors also will affect the price or the coupon rate or interest rate on the bond that governments and corporates issue. So those are the main two types of bonds. But obviously, in other countries, there could even be bonds that are issued by the town councils and the counties, things like that. They are usually called municipal bonds. Okay. Example. Let's talk now an example of a bond that was issued by Kenya. Kenya issued it in 2014, right? In 2014, Kenya issued it. It's very, very fast Eurobond, and it raised, was it $2 billion? And it was a 10-year sovereign bond. The coupon rate was 5 point something percent, and it was raised to finance infrastructure project. That it was, for example, the SGR and some roads. Okay, SGR Expressway. Okay. Okay, but if whether that's exactly what it ended up doing is a story for another day. Okay. Just a minute. Just give me just around 60 or 70 seconds. I'll be back. Okay, let's continue. Mhm. Right. Let's continue. So we have been talking about some of the issues in secondary markets. We said governments and corporates, and we said what they usually issue, the bonds. We have talked about the types of bonds that they usually issue, how they can determine, for example, the price or interest rate or components in each matter. In this case, of the bonds that they issue. Okay. So also in the secondary markets, the other main players or other we are still in the participants in the corporate in secondary markets. I hope you can even track where we are. Okay. So apart from governments and corporations who issue bonds, for example, sovereign and corporate bonds respectively in secondary markets, there can also be investors. There can be institutional investors, for example, pension funds, mutual funds, insurance companies, banks, okay? And other, for example, what we call them, what do we call them? These venture capitalists, okay, who also act as players or also buy and sell shares at the secondary markets, okay. We find that these investors will provide capital by purchasing the shares, either in equity or debt, in shares or in bonds, okay. As I said, there can be pension funds or even retail or even, what we call just normal Kenyans like you and me, what we call individual investors, okay. For example, so now let's say a company or an investor wants to buy shares of a company. What we call, so now their portfolio or their package or their investment package in a company will consist of, for example, they want to invest in equities of a company or the bonds of a company. For example, they can choose maybe between the mix of different companies' shares. Okay, what we call in the process of diversification. Okay, a diversified portfolio consisting of maybe the shares or equities of companies, and these companies, we'll talk more about the diversification strategies and investment strategies. For example, they should not just invest maybe in the shares of different companies in just the similar sector or in the same sector. If you invest in the shares of Safaricom, you can also diversify from other company that is maybe from the energy sector, okay? A little bit of another company from the finance and the insurance or just service industry, or another company in the agricultural sector, things like that, in the healthcare sector, in the energy technology, or in the tech sector, things like that. Okay, they can also even choose between also a mix of maybe both debt and the equity. I mean bonds and equity. They can also invest in a little bit of T-bills and T-bonds. Okay, also even corporate bonds, for example, bonds that are issued by corporations. All right. Yes. So now after looking at that, so now I want us to now look at now the last group or the last classification of players in a typical secondary capital market. Okay, there can also be, in addition to the main issuers and also the issuers and the investors, there can also now be intermediaries that are linking now the issuers, government and corporations, okay, to the investors, both institutional and individual investors, okay. So intermediaries are middlemen basically who connect or who link up the issuers of bonds and shares, okay, to the investors who wants to invest in such bonds and shares, ensuring that and that's where, for example, the benefits, the retirement benefits, RBA may come in. That's where the pension funds and other investment banks, for example, I&M, okay, can come in. There can also be insurance brokers and other brokerage and other, they usually called what brokers, just brokerage firms can also come in, okay. So yeah, even the stock exchange itself, in this case, is an intermediary because they facilitate, provide the platform. Okay. For example, now the NSE, the Nairobi Stock Exchange, in this case will treat it as an intermediary in this particular transaction of connecting, for example, the issuers of bonds and shares to to those who are interested in buying or investing in such bonds and shares. So NSE, we have also even some of the biggest world exchanges, Nasdaq, NSE we'll also look at them in detail. They host some of the big five, for example, Microsoft, Amazon, Apple, okay, are both listed on Nasdaq and NSE. Okay, Tesla is also listed, things like that. Okay, so you find that, for example, let's say you are an intermediary. Okay, you want to advise, let's say, a company who wants to do an IPO. Okay, you are an intermediary who wants to. I want just us to do a little bit of activity so that to drive the point closer home. Okay, so let's say you are you want to the company you are advising is let's say which is a startup in what field? The latest field, that is the tech, let's say tech startup. It's a tech startup, okay? So you as an investor, or you as the intermediary, let's say you are an investment banker, or you are working at an RBA, you want to advise a customer, or the customer, in this case, the company that wants to do an IPO, okay? So you'll prepare the prospectus, as we said, as we did yesterday, highlighting what their mission, their vision, okay, the products that they offer, what they intend to do to use this money that they raise from the IPO to do, for example, their financial performance, both recent and forecasted, okay, and their generally their potential, okay. So you will also need to conduct a thorough evaluation, for example, of the prices. For using, we'll look at that, how to even conduct the pricing of their shares, of their initial pricing. Especially, you can use discounted cash flows. We'll look at that, don't worry, a little bit later. Okay, the price ranges that they should price the shares at. Okay, which investors they should target. As I said, in an IPO, they can target both retail, but especially institutional investors, as it is usually cheaper. Okay, they can target mutual funds, they can target pension funds. Okay, which are typically known to have the enough capital to purchase, for example, even large portions of the IPO. Okay? And they're usually credible. Okay, but also even a retail investor are not a bad go-to. Okay, so yeah, so you will also need to pitch, for example, the liquidity. I mean, how much you are going to raise. Okay, both for the early investors and also for even in the futures. Okay. Mm-hmm. So that's that. So I believe we have internalized. We have known how now the different players in a basic capital or in a typical capital market, both in the primary and secondary markets, all play out what they trade in, what they even their relationship to Inaja, how they link up through an intermediary. We've known that. So now, as I was saying before, so now let's look at now the role of capital markets in economic development. So now just a quick recap of what we said. We said that they help in capital formation, where capital markets, both the primary and secondary markets, will help play a very, very important role in, for example, in generating capital for companies or for the government, okay, and which now will in turn lead to, for example, the companies or the corporates growing, or the government, for example, undertaking very, very good infrastructure or development projects in general. But also, capital markets help in globalization, okay? Since you find that most companies are even these days listed in more than one exchange, or even in multiple exchanges, both even in the global scale and also in the local scale. So when you are listed, for example, in the capital markets, will help a company to even raise capital, or even from international investors. For example, an investor from USA, okay, or from any part of the world, without capital markets, without now, for example, the exchanges in the secondary markets, okay, in the intermediaries. They can't invest, for example, in the shares of Safaricom. Okay, an investor from Kenya like me, without the capital markets, it would be very, very hard to invest, for example, in the shares of Tesla or Apple or Microsoft. Okay, but with capital markets, I can just log on an Investopedia or in any trading platform, and I'll be able to invest in such share. Okay. Lastly, let's look at now some of the emerging trends or emerging technologies around capital markets. We know that should be the next. So we know that there is a very, very huge development, for example, of things like the Bitcoin and the whole blockchain technology, and also even in AI, especially in market predictions. Okay, so there is a very, very fundamental strides and steps being taken in technological and innovation, especially in capital markets. Okay, and it's regularly changing how even capital markets and, for example, trading in shares and stocks, in shares and bonds also, even how it is transforming the whole trading landscape and process. Okay, and even how investors even come up with their portfolio, the investment strategies that you use, the risk management strategies, the portfolio mix and combinations that you invest in and you as an investor diversify in. So now you can find that is being informed by things like AI. With AI, for example, you can correctly even or almost certainly predict, for example, the performance of a company. Okay, you can even analyze, for example, the share price of Microsoft or any company or Safaricom for the past 20 years, and therefore you can even predict the trend. Okay, you can analyze the market trend in Kenya, for example, or the commodities markets in Kenya or in the world. Okay, so it's a revolutionizing the whole space. Okay, but now Bitcoin, we say now Bitcoin is it's called the whole blockchain and cryptocurrency landscape. Okay, for example, you find that even some cryptocurrencies are already being integrated into the some cryptocurrencies are already starting to be integrated into stock exchanges. Okay, you find that, for example, a stock exchange like Nasdaq already uses a little bit of blockchain technology, especially in private market transactions. And since it's faster, it's more transparent, we know how the DEX, decentralized exchanges work, and therefore why customers, for example, at an exchange would prefer such a blockchain technology to be incorporated, for example, in private market transactions, and just to enable secure trading. Okay, it's usually regarded, it's held, I mean, that's its main feature, it's security and also transparency. Okay, so if you can get the technology that will ensure that there is secure trading, you as an investor, you'll embrace it a lot. Okay, but another, moving from that, even you remember what I was alluding to yesterday, ESG and the whole green funding and the climate action. That is also even affecting even how companies even trade. Okay, you find that there is increased awareness on environmental, social governance, climate action, green funding. Okay, so there is a increasing shift, okay, towards investors to invest in companies that are aligning, or in portfolios that are aligning with those, for example, with the fundamentals of ESG, environmental protection, things like that. Okay, for example, you find a company's shares will be determined by, I mean, for example, their environmental resilience. Things like if you are a green company or a green startup that is focused on green or climate action or green energy generation, things like that, that will inform investor confidence and also market perception, investor perception generally in the shares of you as a company. Okay, I hope you can understand. Next, let's now look at financial instruments that are traded in capital markets. I have alluded to a lot over over the course of the past lectures and trainings. Basically, so now we said financial instruments are basically the financial commodities that are traded in capital markets, but it can either be in the primary and also in the secondary markets. Basically, they are usually equities, fixed income securities, and derivatives. Okay, we have talked about what equities are, fixed income securities, and also derivatives. So let's start with the equities. Equities are basically stocks and shares. Okay, and they're basically the ownership of a company. So if you want to invest in the shares or in the ownership of a company, then you buy their stock, and the much stock or the much share that you buy in a company will for example, will inform how much of the company you own. Example can be either in the form of common stock or preferred shares. Okay, so when you purchase the shares of, let's say when I purchase the shares of Safaricom, okay, it's like I also become part of at least a partial owner of Safaricom. Okay, and therefore, when Safaricom announces that they made 50 billion in earnings in the last quarter, I'm also a part of that 50 billion. I mean that I'm entitled to a part of that 50 billion that is commensurate or that is relative to the amount of share or the portion of shares that I hold in Safaricom. So let's look at common stock and what is common shares and preferred share. Okay, it's usually common stock is usually the most common. Okay, especially it will offer you'll be able to have voting rights in for example in the decisions of Safaricom, and you have the potential, for example, for growing. Okay, let's say the price of Safaricom shares and or even the dividend prices or the dividends of Safaricom appreciate or grow. Therefore, if you hold common shares in Safaricom, then you will benefit, though sometimes dividends are not guaranteed. A practical example: if you invest in Safaricom, then you have the voting rights. And when they invest, for example, when they invest and grow in technology, things like that, therefore you can benefit from their continued market expansion, things like that, and also in their growth. Okay, since especially if you invest in companies that are very, very good futures and very, very good market perceptions in terms of their growth capability, their market share, market cap, things like that. As opposed to when you invest in preferred shares, okay, or preferred stock, okay, it in this case it will offer you fixed dividends. Okay, especially if you are an investor who is interested in stable earnings or stable income, then this will be investing in the preferred shares of a company would be most preferred for you. So now you'll find that you would have a higher claim or a priority claim on the assets of that company. Let's say the company is winding up because of maybe in any reason, then you will need to be paid first. Okay, but usually you don't have voting rights on the decision of the company. Okay, things like in AGMs. Okay, let's now let's see how these work. Okay, how do they work? Okay, that's the second. You can see. So now we are in equity stocks and how they work. So now, how do they work? They usually work and are traded on trading platforms. Trading platforms are the stock exchanges. Okay, the Nairobi Stock Exchange, global exchanges like the New York Stock Exchange, one of the biggest, and Nasdaq, and also another one of the biggest. Okay, so you can find that if you are a company and you are listed on the stock exchange, for example, the Nairobi Stock Exchange, then it will give you access to a wide variety of not only institutional but also individual investors who can subscribe or buy your shares. Okay, therefore, in that way, it will increase your market cap and also increase, for example, your liquidity, basically your capital. Okay. There was something that you alluded, that you were asking yesterday, that I'd like to even allude to, also touch a little bit on right now. That was on valuation. You as an investor, how do you value, for example, which company to diversify it, to hold a long position of a portfolio in or not, okay? So, as I said yesterday, there is one called fundamental and technical analysis. So, one, as an investor, you can evaluate, for example, the shares of Safaricom or the earnings of Safaricom's and its future potential. For example, as we say, Safaricom has a very, very good investor perception, and therefore you as an investor, you can evaluate their market perception. Therefore, when they have a good market perception, their growth potential, for example, they are very stable, their growth potential is high. Okay, so when you evaluate such factors, for example, based on what their earnings in the last quarter was, okay, the amount of assets that they have, for example, especially risk-weighted assets, then you do, in that case, you as an investor will be doing what we call fundamental analysis. If you are an investor, you want to analyze Safaricom shares, their financials, their latest financial disclosures, what their shares subscriptions are, okay, what they do, for example, their products, okay, the products that they launched, okay, their forecast of revenue that is usually contained in a prospectus, okay. You can use that to forecast and to determine if investing in such Safaricom shares is worthwhile or not, okay. It can even be to gauge whether the shares, the price that they sell their shares at is an evaluation or an overvaluation, okay. As opposed to when an investor does technical analysis, which is basically you analyze, for example, their prices, okay, things like their price movements, the trends of their prices, especially, for example, their past and future prices, for example, okay, and other indicator, okay. Then in that case, you will be doing what we call technical analysis. Lastly, let's also look at fixed income securities. Fixed income securities, as I said, they can either be the bonds that are going to be issued by a government or a company or a corporate, okay. We had talked about the various types of bonds, government bonds, corporate bonds, the various types on each, the various natures of each, various companies that have issued corporate and governments. So the instance of, for example, where the Kenyan government issued government bonds, for example, the Euro bond, we looked at that. So we won't waste any more time on that. Then let's look at now the last, the derivatives. Okay, derivatives. We are still on the financial instruments that an investor can trade in at a capital markets. Derivatives. We have talked about equities. We have talked about bonds, fixed order. We usually call fixed income securities. So now let's look at derivatives. And as I said before, there are basically options, futures, and other hedging and other risk management or hedging strategies. Let's start with options. Okay. We said, you know the definition of, basically what derivatives are. Derivatives are basically instruments, investing in instruments that is pegged on another instrument, especially, for example, an interest rate. Okay. So when you want to hedge, for example, against interest rate risk and interest rate fluctuations, okay. Therefore, let's say you use a derivative, let's say an interest rate option or an interest rate swap or an interest rate futures contract. Therefore, that interest rate futures will be the derivative, because the value of that interest rate swap, okay, the price of the swap or the risk rate associated, the benefits of that swap that you enter into will now be with the investments, will be based on now the interest rate risk that you are trying to hedge against. So basically, there are financial instruments that are pegged on the value of let's say interest rates or even stocks. when you want to hedge against the stock price fluctuations, therefore, the value of the, or let's say you want to use an option, the value of the derivatives is now will be derived on the underlying asset, in this case the stock price fluctuations. It can even be bonds also. Okay, derivatives can also derive the value from bonds, obviously both bond stocks and even commodities like oil and what, and gold. Okay, options. So let's start with options. Options, basically there are two. Options is basically a contract that gives you the right but not the obligation to buy, for example, when you to buy or sell a security or an instrument at a future date at a predetermined price. Okay, a call option, if it gives you the right to sell, it's a put option. To buy is a call option. So basically, a call option will give you, if you are hedging against, let's say you are hedging against the stock price fluctuations using a call option, it will give you, as the hedger or as the holder, okay, the right to buy an asset, the asset or the stock in this case, at a fixed price or at a predetermined price, okay, in the future. I don't know if you are understanding me. For example, when you purchase a call option of, let's say, Safaricom stock or Safaricom shares, with they're usually the price, the underlying or the predetermined price is usually called in investments and capital markets, usually called a strike price. Okay, so when you as an investor invest in a call option or buy a call option of let's say Safaricom, okay, with a strike price of, let's say, what's this Safaricom shares right now, 2025, let's say 30, okay, the strike price that you buy the call option against Safaricom shares is 700, or I mean, no, 25, that, so 30, let's say 30, okay. What that basically means is, now if the price Safaricom shares or stock price rises above 30 bob, then you have the right, but you don't have to. Okay, you can exercise your right to buy Safaricom shares at the 30 bob that you pick them at. But let's say they rose to, let's say, 40, then you can buy them at the 30 bob that you bought them at, you bought the option at, but sell them at the prevailing market rate. Let's say it rose to 40. Okay, I don't know if you are understanding. Let's say you are an investor, you want to invest in Safaricom shares. Safaricom shares is 25, but due to stock prices fluctuate and things happen. Okay, you as an investor will go and buy a call option on Safaricom shares. This is just an example. Okay, on Safaricom shares with a strike price of 30. That is in November. Let's say next year Safaricom shares are 40. Okay, you won't buy them at 40. No, you'll buy them at what you agreed on, the strike price, that is 30 bob. And then you'll sell these shares of Safaricom at 40. You will have made a 10 bob profit on each share of Safaricom that you hold, and therefore you will have made a profit. On the converse, or on the contrary, put option basically works in the reverse way. If you buy a put option against Safaricom shares, it will enable you, it will give you the right, but not the obligation, to buy the Safaricom shares, or in this case, to put is to sell the shares at a fixed price. Okay, especially, it's usually all these we're talking about are hedging or risk mitigation strategies. You don't want to take that risk of either Safaricom shares fluctuating, going up or down. Okay, so let's say in this case, as I said, it works in the converse or in the reverse way, in the opposite way. Let's say you as an investor buys a put option on Safaricom shares with a strike price of, let's say, of 20 bob. Okay, so since
since Safaricom shares can also come down, just as they can also go up, they can also come down to even 15. Okay, so if Safaricom shares, let's say next year, they are now at 25. Let's say, and the US strike price was 20, right? Let's say next year they come to 15. Then you'll have the option to sell them at the strike price that you bought them at. That was, what was your strike price? 20 bob, and not at 15. Because if you sell them at 15, you'll have made losses. You bought them at 20, but you sold at 15. You've made a 5 bob loss. But since you took a put option, you hedged against that risk, you'll exercise that right of yours to sell them at the 20 bob. Therefore, you will have not made a loss. Okay, you know, in investing, they say it's you'd rather not make a loss than you'd rather not make a profit than make a loss. Though that seems like an oxymoron, or the same thing, but it's in investing. I have in my postgrad teacher lecturer used to tell me they are very, very different thing. He used to tell us they are very, very different things. Investing, especially to an investor. Okay, you'd rather not make a profit than make a loss. I mean, let's say Safaricom shares fell to 15. You'd rather sell them at 20 bob and not have made any loss or any profit than sell them at 15 and made the 5 bob loss. All right. Let's continue to the other another type of derivative, futures. I have talked about this before. Futures are basically contracts that give you the right to buy or sell Safaricom shares, in this case, at a future date for a predetermined price. Okay, if we agreed with you today that I'll buy these shares or sell them at 20 bob, even in the future, it will give me, I'll have the contractual right to buy them at the price we agreed, regardless of market fluctuations and prices fluctuations. They're usually used especially in commodities trading. When you want to lock in a price of a commodity, let's say of gold or oil, then you'd rather, or even of agricultural produce. It's basically how barter trade started. And it's usually even used. Let's say you are a farmer in Rift Valley. Rift Valley is known for producing the bulk of Kenya's maize, right? Okay, and since sometimes maize prices due to a whole lot of factors. Sometimes maize prices come to 3,500 bob per bag. Okay, sometimes they climb to 4,000. Sometimes they come back to 2,000. So as a farmer, let's say you are you farmed or you produced some maize. Okay, you don't want to take that risk. Okay, so you can. This is just an example. Okay. These are an example. You can hedge yourself against the fluctuations of maize prices by taking a futures product. You agree with another party. Okay, it's basically an agreement or a contract between two parties to exchange that maize at let's say if we agreed on 4,000, whether it comes back to 3,500, I don't care. It will be, I'll sell to you or I'll buy to you at the price that we agreed in or at. Okay. Let's also look at just a minute. So can you see where we are? We are on the third concept, that is derivatives, option futures, and hedging strategies.
Yes, I can see.
Yes. So now let's continue. Let's also look at now the alternative investment. In addition to now investing in shares, bonds, and the derivatives that we just talked about, some people can also even in capital markets, there can also be investing in REITs, what we call real estate investment trust. Okay. Also, even basically investing in REITs is basically you can own a home but not actually own a home. You can build a home but actually, and be receiving rent, but not actually having or the home or the property or the real estate property that you are invested in, you are investing in. Or even it can also, some other investors also invest in commodities, especially in wheat. These agricultural products are usually largely invested in. Those are some of the commodities that are invested in largely in commodities markets, and usually there are some commodities but currencies that even some investors may prefer to invest in. For example, the non-commodities backed currencies, the Australian dollar and the Canadian dollar. Okay, you can also even invest in gold, oil. Okay, but gold especially is used by governments, especially when you have heard of gold-backed currency. Okay, gold reserves. Okay, those are just basically to hedge or to back a currency, especially against inflation, and that's basically that's how most banks survived, or most countries that survived, countries whose banks survived the 2008 financial crisis had very large investments in commodities, especially gold-backed investments and reserves. Okay. In addition to investing in rates and commodities like gold, oil, and wheat, things like that, you can also even invest in private equity, what we were talking about yesterday. Basically, what private equity is it's like venture capitalism, or being a venture capitalist. I told you an example of a venture capitalist or private equity firm yesterday. Basically, you look at startups or companies just starting out, or you as a venture capitalist or a private equity firm, you look at companies that are started private and then you buy them out. All right. Basically, that's it. Or you look at a startup and then buy it out or invest in it. Okay, you can fund its startup and fund its founding or operations. Okay, but you usually find that they're usually long term, because especially if you fund a startup, okay, it's usually very liquid. You cannot easily liquidate your investments. It is based on the performance or growth or not thereof of the firm you are trying to fund. Okay, and therefore we have also talked about diversification. Diversification is also another method of investing. I mean, you can diversify, for example, between many currencies or commodities or investment portfolios. Okay, can have what we call ALM, asset liability management, especially in bank treasury. Okay, a mix of a little bit of assets and a little bit of debt or liabilities. Okay. What else? As I said before, we can also even in evaluation of, let's say you as an investor wants to now evaluate which company to invest in. You can also even, as we said, you can look at it. For example, it's for future cash flows or predicted cash flows, things like their earnings, things like their value. Okay, but you can in this case you'll need to discount the. I hope you know how to, for example, calculate the present value, for example, the earnings of a company to value. If you are an investor, you want to invest between two shares, you can compare between the intrinsic value or the present value of the cash flows of two companies and know which one to invest in, or which ones are undervalued and which ones are overvalued. Basically, it's basically discounting the cash flows as presented in their earnings reports or in their prospectus. Okay. Just a minute. Okay. So Let's look at now the third, equity markets and valuation. So now let's we have talked about equity markets before, but now let's a little bit delve into deeply into it. Okay, basically it's now stock trading and stock buying and selling and valuation, things like that. Okay, that's what equity markets is all about. Okay, buying and selling the stocks of companies, especially those are at a stock exchange. Okay, we're talking about capital markets and investment. So now let's start by looking at some of the trading mechanisms at the equity markets. Okay, we have talked about the components and the players at equity markets. We obviously the stock exchanges. Let's say it's at the Nairobi Stock Exchange or Nasdaq, London Stock Exchange, Chicago Mercantile Stock Exchange, China, it's usually called Shanghai Stock Exchange, things like that. Those major stock exchanges, Tokyo Stock Exchange. Okay. So the trading mechanisms for an investor, there are basically three types of trading mechanisms that an investor has in for example, at a stock exchange when they want to invest in the equity market. We are in the third, I hope you can see. Okay. So now there is one that's called usual called market order, where you basically buy and sell shares based on the current market price, as opposed to limit order trading, where you buy or sell shares at a specific price. Okay, and there is also another one called a stop loss order, where you sell the shares based on with a view to limit your loss, especially should the stock price of that company that you are investing in fall. Okay. Now let's now try to look at now the role of, let's say, the Nairobi Stock Exchange in facilitating trading of in companies' shares that are listed with it or in it. Okay. So the Nairobi Stock Exchange, it will provide liquidity for companies. For example, it will facilitate the companies to issue debt and also issue shares, therefore, to get money or to get liquidity, for example, to fund their operations. And in the process, therefore, it will ensure the stability of such companies. So let's say a company is undergoing economic or financial distress, then they can issue debt or equity, therefore, to get liquidity and hence ensure their stability. That's how even most banks survived. You remember when not even banks, let's say any company is undergoing financial distress and almost collapsing or unfavorable market conditions, they just issue additional capital, especially to balance their books or to balance their ALM strategies, asset liability mixes and strategies. Okay? There are obviously the other big stock exchanges that also host some of the biggest companies, what we call the S&P 500. Okay, for example, the New York Stock Exchange, which is considered the largest in the world by market cap because it hosts some of the biggest companies by market cap in the world. For example, the Big Five. Okay, but even in other companies, even Coca-Cola is also listed there. Okay, so yes, that's basically the role the role of such stock exchange to companies that are listed with it. It ensures their stability and also provide them with an avenue for raising capital. Okay. I will share you with some notes with a link. To that link, there is a link to the how to analyze, for example, the stock. If you want to analyze the stock of, let's say, two listed companies, and see, for example, and compare the type of shares that are listed with each. Okay. You can compare between, for example, how the stock of Safaricom has been performing against that of let's say Kenya Power, things like that. So to an investor, that will help you, for example, in formulating your valuation and investments and portfolio strategy as you approach that trading in such a market. Mm-hmm. I'll also get you notes on how to even, if you are an investor, on an actual and also even a more or a hypothetical scenario where you'd want to maybe see how to do the type of analysis or valuation analysis and techniques that we talked about. When you want to, for example, value the performance of a company, or whether to invest in a company based on their earnings, things like earnings, based on their market cap, based on their, for example, PE ratio, that's price to earnings ratio, based on what their last revenue in the last quarter that they announced was, things like that. How to use those parameters and those indicators to even formulate your analysis on which shares or which combination of shares to invest in, or which diversification strategy to use in investing in such shares. Okay. Mm-hmm. Because it's from those analyses, then therefore you as an it's from those analyses, then therefore that you as an investor can decide whether the prices of a company are undervalued or are overvalued, and therefore if they're overvalued, you should what position should you hold, a long or short position. If they're undervalued, therefore there is a possibility of them gaining, therefore you can invest in them or hold a long position in investing in them. For example, from just analyzing their values, their price to earnings ratio. Okay, I hope you know the formulas. For example, of calculating the price to earnings ratio, things like the discounted cash flow methods, right?
Yes, I do.
Yes. And therefore and then let's say I'll also get you, for example, I'll get you some, but I have the complete notes of even the formulas, and then therefore just as a practice, you can also even look at those formulas and then therefore look at a hypothetical company. Let's say compare Safaricom. Okay, if you can get their data, it's very publicly available. Get their data, try to calculate their market cap, okay, and market share price from the various valuation techniques, fundamentals, and technical analysis, and then compare that with the actual price at the NSE right now to know whether the shares of Safaricom is undervalued or overvalued. Okay. Things like, there can also be even the earnings per share. There's a whole lot of metrics that as an investor in a fundamental analysis that you can use. Okay, basically there are a whole lot of, you can look at their, for example, even their EPS, that is earnings per share. Okay. Okay. I hope you can see. I've talked about how, for example, you can the types of market orders, order types, the market and limit order and stop loss orders. I've talked about that. Just a minute. Yeah. I've talked about, for example, the stock valuations, fundamental analysis, and the PE ratios. Those are the metrics or parameters you can use in your analysis to determine the value of a company or the valuation. Okay. So now let's now look at the case study, how to analyze market opportunities, especially in emerging markets. Emerging markets are basically economies or countries that are considered to have that potential to grow. Okay. So let's say you are an investor and you want to invest in an emerging market. Okay. And a market that has
as the opportunity or potential to grow. What factors will you as an investor look at? Okay, for example, if it's the economy of a country, you look at that particular or specific country's GDP, because that is usually a very good indicator. For example, the economic growth potential of that country. Okay, for example, also that consumer spending, things like per capita income. Okay, consumer expenditure. Okay, you as an investor obviously can also will also look at, for example, the political situation in that country. That's usually informed most of the investment decision or investment decision of investors who want to invest, for example, in highly politically volatile countries like Kenya. You find that when politics are usually high, even the investor confidence in such a market is usually lower. But it doesn't even not only need to be now political instability of a country. It can also even be the political governance structures or political decisions in a country. For example, the tax regime of a country, even the process of investing. I mean, what are the requirements? Okay, we live. What are the taxes? What are the fees involved? What is the process of even registering or incorporating a company if you are to? Okay. We will also even look at now that particular country's currency, for example, forex risk. Okay, forex fluctuations, especially for example in Kenya. If you are a US investor, you will analyze the performance of the Kenya shilling against the USD, for example. It's usually considered to be very, very volatile, and therefore that can inform the valuation technique or the market opportunities that are presented to you. Okay, as an investor, maybe you as an investor want to invest in such, for example, exchange rates, especially let's say you want to invest in the derivatives, exchange rate derivatives. Okay, that can present an opportunity. Okay. So in addition to that, you as an investor can also do what we call a SWOT analysis. Can analyze, for example, the strength, the weakness, the opportunities that are presented, and also the threats that are presented by investing and not investing in an economy or for example, in an emerging market. For example, let's say you want to analyze the SWOT analysis. You want to do a SWOT analysis for investing in Kenya, for example, which it's usually not an emerging market. Emerging markets are, for example, these South American countries, Brazil, South American countries. They're usually considered to be emerging markets, okay? Because, for example, their population, natural resources, they are considered to, for example, have a wider base of middle class, okay? And generally, and in comparison, their governments are relatively stable compared to standards that we set as Africa. Okay. Anyway, so let's say you as an investor wants to analyze, okay, the market opportunity through a SWOT analysis or investing in an emerging economy. Let's say in South America, okay. Let's say which country is in Brazil, okay. That's the first country I can think of. I'm an Arsenal fan, and one of my best players, defender, Gabriel, is from there. Okay, and Martinelli. Okay, so Brazil is usually considered, it's one of a very, very big economy in South America, okay? And it has, as I said, the economies are usually even in multi-sectoral, for example, things like agriculture, things they have mines, natural resources, energy, manufacturing industries in such countries. So as an investor, while doing a SWOT analysis, or you look at those strengths, for example, the opportunities that are presented. Okay, it's a large. Their populations are almost 4 times that of Kenya. Okay, the natural resources. Let's say you are an investor in gold or oil. Okay, that are available in such an economy. The presence of a wide base of, for example, middle class, therefore markets. Okay, or even as I said, even
stable politics and government policies and the stable governments generally. Those can be some of the motivations or the strength that you as an investor will focus on or look at. But obviously, I mean, there must also be weaknesses. For example, I mean, they aren't 100% politically stable. Okay. There are also economic volatility, things like their interest rates, things like that are very, very volatile. So those risks and against those opportunities, then you'll compare against the opportunities that are presented, as I explained before, okay, against the threats, for example, that are presented, for example, the political threats, currency fluctuation threats, things like that. So as an investor, you'll all evaluate that, and therefore to know how to, for example, to invest or not in such an emerging market. Okay, so you will explore the high growth potential in, for example, in emerging markets through looking at now both economic indicators, the political indicators, and also even industry indicators. We had talked about fixed income. That's our next module.
Just a question, what industry indicators are there?
Industry indicators, for example, you look at a specific industry, let's say the manufacturing industry or the agricultural industry. What in agricultural industries are presented in that emerging market that you're looking at? If you're looking at the manufacturing industry in Brazil, how developed or not is it? Okay, what are the, for example, the market opportunities that are even in the manufacturing opportunity? For example, in terms of availability of manufacturing raw materials, and also even the market or consumption. As we said, for example, that their population, especially the middle class, is usually wide. So therefore, if you want to invest in the manufacturing industry in an emerging market like Brazil, then therefore that can be a motivation or a strength or an opportunity that you look at. Okay. Yes. Let's look at
yes,
fixed
that's
income.
okay.
Yeah. Let's now look at fixed income markets. Most of these things we'll be doing a lot of repetition, but that's okay since it enhances understanding. So just a quick recap: we have talked about fixed income markets, and basically we said it's the government bonds and treasury, treasury bills and bonds, and also the corporate bonds that can be issued by a government or by corporates, respectively. Okay. So as an investor, let's say, so now we want to look at now. So now, what is the one risk that will affect? The concept is to now look at that, look at those fixed income markets, okay, in relation to, for example, the risk that they face, which is obviously in the case of, for example, corporate bonds and municipal bonds, corporate bonds and government bonds, it's usually the coupon rate risk or the interest rate risk. Coupon risk in bonds is called coupon. Interest rate risk. Interest rate in bonds is called coupon. So now, for example, the interest rate risk of investing, for example, in government and corporate bonds. We have talked about what they each are. Okay, so let's try to compare. For example, and I think we did. Let's try to compare the interest rate risk or interest rates, for example, between the corporate bonds and the government bonds in Kenya. So, for example, the government bond in Kenya is issued by the Kenyan Treasury. Okay, when they want to fund, for example, some agricultural or infrastructure operations. Okay, or when they want to pay some external debt, things like that. Okay, so the yield or the return of Kenyan Treasury bonds, as we said, they are usually lower if you compare them to corporate bonds, okay, or the other types of bonds, because they are low risk. The lower the risk, the lower the return, as it's said in life generally. For example, a 10-year, you'll find that a 10-year Kenyan Treasury bond might yield around, let's say, 15% annually, right?
but also obviously depends on the prevailing market conditions. And bonds, especially government bonds, treasury bills and bonds, treasury bonds or sovereign bonds in general, are usually long-term bonds. And I haven't heard of usually even 10, even up to 30 years. Okay. As I said, they are usually considered riskless investments because you find that they are backed by the economy of the or by the government, and therefore default risk of the government defaulting to pay your interest and also principal is almost non-existent. And even in the terms of tax exemption, well, they're usually tax exempt, but there can be cases of taxes, especially in other jurisdictions and in other governments. Okay, let's look at now also in comparison to now a corporate bond. We have done this before, but just a quick recap. We've said that corporations, especially let's say Safaricom, or even in the world on a global scale, let's say big corporations like Microsoft, Apple, the big five, or even Tesla, they usually tend to issue corporate bonds, especially when they want to raise capital when they want to expand it into a new line of business, or they want to research on some, let's say, some technology or innovation, or they want to even buy another company. When Alphabet, the parent company of Google, wanted to acquire YouTube, Google, or all the other companies that they acquired, you find that they tend to issue corporate bonds. Okay. If you compare, as I said even before, if you compare them to the treasury bonds or sovereign bonds, they are usually riskier. Therefore, they have higher returns or yields. Okay. Therefore, as an investor, that has to be taken into consideration. For example, you find that on a global scale, when, for example, a big company like Microsoft, okay, issues a bond, they usually even issue it at let's say a 6% coupon or yield rate. Okay, obviously depending on as we say, corporate bonds also are pegged on the credit rating of that company. Okay, but those are usually very, very good companies with good credit ratings. But it depends. It will also influence on the yield rate or the coupon rates or interest rates that they pay you. Okay. Also similarly, just as treasury bonds, they're usually also long term, but they can even be from as short as 5 years to even to as long as 30 years. Okay. But most companies, like, let's say, you issue 10-year bonds. Okay. Risk, we have talked about their risk profile. They carry obviously the credit risk, okay, because it is pegged on the credit rating of that company. Their likelihood of defaulting to pay you your interest or your coupons. Okay. I have notes for you also on the formulas, for example, on calculating the yield rates and also the coupon rates of bonds, for example, the YTM, things like that, to maturity of both the T-bills and corporate bonds. I'll share them to you, but obviously you know how to calculate. Won't waste too much time on that. Okay, so let's try to compare. I just want to give you a summarized or a condensed summary of now the different types of those bonds. Let's say, as I said, some jurisdictions, especially let's say in the USA, you find also even in the states or the towns, or what we call municipal bonds. The towns can also issue, let's say the state of New York, or New York, is it a state, or the municipal town of New York, okay, or that city can also sometimes issues bonds. Let's also now let me give you now a condensed. I have here a condensed comparison of now the three different types of bonds that can be issued by a government, a company, or let's say a local government. Okay, so for example, let's say now, since Kenya, I have never heard of municipal bonds. Let's talk of now the USA, where I know actually I know for example, the state of New York usually issues as a bond that they issue municipal bonds that they issue
that is issued by the local government of New York. Okay, so the issuer, let's say, so now in the USA, the treasury bonds that is issued by the USA, or the treasury bond that is issued obviously by the US Treasury, the Department of Treasury, okay. Issuer, for example, on corporate bonds are issued by big corporations, for example, as I said, the big five, and the municipal bonds are issued, on the other hand, are not issued by the government or by corporations, but are issued by the local government. The yield rate of such of treasury bonds, you find that they can be, for example, 4%. Corporate bonds, they can, since they are a little bit riskier, 6%. Municipal bonds are usually lower than corporate bonds, but higher than treasury bonds. So let's say 5%. Maturity period, as we said, treasury government bonds or treasury bonds, they usually 10 to 30 years. Corporate bonds, 5 years, but municipal bonds can even be used for a year. Okay. Risk rating and also risk profile, as we have talked a lot about, the one that are considered to be riskless or risk-free, the risk-free rate, treasury very low risk. Okay. Corporate bonds high risk. Okay. Also, municipal bonds are also considered to low risk. Taxation, you find that yeah, they are not tax exempt. Credit rating, it only applies to the corporate bonds. Okay, doesn't apply to the other types of bonds because they are riskless. Okay. So yes, what else I'm trying to look now? So now let's try to look at now the yield curves. Now that the second concept under this. But then these days there you don't even need to when you I told you I'll give you the formulas for even calculating the bond prices, things like that, the yield rates. But these days there are even softwares. Even the government of Kenya, when you go to the CBK website, there is a site you can easily calculate the bond price. In fact, I think that I can even show you right now. Let me just try to present my screen so I show you. Okay, can you see my screen?
Yes, I can.
Okay, let me try. I want to share my whole screen. So I show you even a very, very simple way of how to. You can see my screen, right? I want to do it on my mobile phone, so it's easier.
Okay.
Say, CBK. It's usually CBK bond calculator. It's usually treasury bonds. Yeah. Bond price calculator. Treasury bonds calculate. Yeah, here. You see? So let's say face value is usually, let's say 1,000. Coupon rate, let's say 3%. Quoted yield, you don't need to. Let's say the maturity is 1 year. Offer price, do we need to input anything? Or coupon rate, also face value. Okay. Calculate coupon rate. See, I've entered that. For quoted yield, let's say the 2. You see? So now the bond price of that bond over 1,000 or 1,000 face value bond
will be 1,000. You see how it's very, very easy. Okay, it automatically calculates even the discount is in case there are taxes, it will automatically populate there. Okay. Okay. What else? What else? How long do you have?
Sorry, what? What do you mean?
I hope you have seen
Yes, yes, yes.
how long do you have?
No, I'm available. I've seen how
All right.
you've calculated it
Okay, yes. So it's that
on the
easy.
website.
We can take maybe you can take a short break, maybe a 10-minute break if you don't mind, and then we come back, right?
Yes, of course. It's actually one. So 10 minutes is, we can do lunch break.
Sure, no problem. And then we'll come back.
Let's say 30 minutes.
Sure.
Okay.
Thank you. See you then. All right. Okay, we can now continue.
Yes, we can continue now.
Okay. Yeah. So for this afternoon exercise, I wanted us to do a very, very interesting exercise. Just before we went on the break, we were discussing about bond price calculations, even using the online bond calculators. There are a lot of them. Almost all the trading platforms, the major trading platforms and treasury, central banks have them. And we just use the Kenyan Treasury Central Bank bond price calculator. So I wanted us to look at a similar example and to now just see if we do the manual calculation, if it should bring us the same value, okay? For both coupon rated bonds and also zero coupon rated bonds. Is that okay?
That
Just
is okay. But,
yeah,
but
just
just so what is the manual process? As in
exactly.
using
So the formulas, the formulas, the bond price formula.
okay.
Yes.
But we're talking about coupons, and I thought that's for treasury bills, not bonds.
Yeah. See, treasury bonds. No, treasury bonds. Even coupons are for treasury bonds. Even
Okay,
coupon is
let's.
generally the term given to interest rates as relating to bills and bonds.
Uh, okay, let's continue.
Okay. So I wanted just to give me a minute. Okay. So we did on the Treasury website, and we found that the bond price was coming, or the offer price was coming to around 1,009, right? Let's start. Let's look at an hypothetical scenario of a coupon rated bond, a fixed coupon bond, and then we will also look at now on the Treasury website. Okay, just as a practice exercise. Can you see my whiteboard?
Yes, I can see it.
Okay. So let's say we have this really work. Don't they have place for typing or something? Just a minute. I don't think this will work. We go to notes. We can be able to share the note, share it as a note. Create new note. Okay, I just shared some notes to you. Can you be able to see? Sorry, hello? Are you able to see my screen? And the notes, just go to notes. If you are able to see, and then open the note.
Yes, I was saying I can see it.
You can see where I even, the last thing I've typed, fixed coupon bond, okay? Okay, so now, what I want us to do, I want us to get an hypothetical, just similarly as the hypothetical bond. So let's say we have a fixed coupon bond of, let's say, face value. Let's say 1,000, it's typically 1,000, okay? But it can vary. Coupon rate of, let's say, 3%. 3%. Quoted yield or YTM. Let's also say, let's say 2.5%. Okay. And then maturity 1 year. Okay. So now we want to find the bond price. Okay. The price you as an investor would pay for this bond if they offered. So now the treasury bond, the treasury government, the treasury of Kenya offers this bond or issues this bond. What's the maximum or the minimum price, the maximum price you'd pay for this bond? So to calculate the bond price, it's basically the coupon, it's usually the coupon rate times 1 minus times 1 minus 1 plus R. You can 1 minus 1 plus R This one raised to power negative n is the raised to power is the minimum. And even take that raised to power negative n, and then all these divided by the rate, the coupon rate, right? But first we'll need to find the face value of the bond, which is usually just the face value plus times 1 plus R raised to power negative n. So that's usually just a PV of the face value is usually just the face value times 1 plus R raised to power negative n. Okay. So face value times 1 plus r raised to power negative n. Okay, so then let's start. So now we have the face value, we have the coupon rate was 3%. Okay. So now the coupon payment will be the, see, it's usually the coupon rate times the face value. Okay. It's so 30 bob. Because in the coupon rate, the coupon payment will use the coupon, the C times 1 minus 1. So the C will use the coupon payment. That is usually the coupon rate times of the coupon rate times the face value, right? I hope you know that. So in that case, it will be 1,000 to get the now the coupon payment. It's usually the coupon rate times the face value. Okay. Therefore, which is 1,000 times 3%. The coupon rate was 3%, 3 over 100, or 0.03. That comes to 330, 30 bob. So the coupon payment will be 30 bob. Okay. So let's just substitute that back in the bond price formula. Therefore, C times, so 30 times 1 minus 1 plus R. The R is 2.5. We use the YTM. Okay. Raised power negative, it's 1 year, a 1 year bond, so raised power negative 1 over the rate 2.5, that's 0.05, 0.025, 2.5, so 0.025. I'm saying, so it's 30. So the bond price, why does this thing not? Bond price is equal 30 times, let's open the brackets, 1 plus, no, 1 minus 1 plus R. R is 0.025, so 1 plus R, so 1.025, 1 minus, okay. So that's like saying 0.025. See, 1 minus 1 plus R is like that, just the R. So it's like saying 30, or let's just 1.025, okay, raised to power negative 1. And then all that divided by the rate, that is 0, what was 0.025. Okay, I hope I've substituted it. 1 minus 1.025 raised to power negative n, and it's a 1 year bond, so negative 1. And then all that divided by the rate, that is 0.025. Okay, but I just did it because it should be just the 1 plus R should be raised to power. Okay, can you calculate what that will come to, please? That should come to just a minute. I have my own calculator here. Calculate. So let's start with the 1.025 raised to power negative 1 point. Just a minute. So 1.025 raised to power just a minute. Okay, 1.025 raised -1. That comes to 0.97, and then 1 minus that. So 1 minus that. 0.9756. And then obviously we'll add the face value, right? The present value of the face value to now get the total. 56097,561. Okay, that comes to that. And then times 30. And then divide by 0.025 means to 29.26. Okay, so 29, right? So 9.025 get 1. Okay, it comes to 1004.88. Can you see? Just a minute. 1. To 8. Okay, so 29.28. So, it comes to 1004.88. So this one comes to 29.28, and therefore, so we said now the PV of the face value is the face value times 1 plus r raised to power negative m, which is so now 1000, that's the face value, times 1.025 raised to power -1. Okay, that will come to 975. $975.61. So plus 975.61 equals to 1004.88. Okay. So I hope you have seen how it has all come about, right? It has come to 1004.88, right? Okay. So let's also now go and try in the treasury, the CBK's treasury bond price calculator, if it will bring the same. It should. I think we use the same parameters. But let's just try and present. Share screen. Okay, so the coupon rate was 3%. Just a minute. Therefore, calculate. You see it comes to 1004.9. So, meaning it's correct. Okay, so you see now how it works. Okay, so yes, so that's how we can calculate, and we can even do so similarly for a zero coupon bond. Okay, very easy. So now we'll just use the YTM. Okay, we'll just substitute. Just a minute. So we'll just substitute. In this case, we'll just substitute, or let's even do it in the Treasury government's website. I mean the CBK website. Okay. So it's a zero coupon bond, so the coupon rate is 0, and then so now what will it come to? 979. Similarly, even when we do it in the bond price formula, it will bring that similar. Okay, so that's how easily we can calculate it to find, for example, which bond the lowest price we can price a bond at, or we can buy a bond at. The highest, I mean, the highest. So it's the discounted, basically it's the discounted price at which, if as an investor, you can buy the bond at, and at the maturity, for which you will receive a face value of 1,000. Okay. So for every 1,000 bond that they are trying to sell us, the maximum that we should pay for a zero coupon bond should be 975, but for a coupon bond is 1,000, 1,004. Okay. So yes, that's all I wanted us to look at. And yes, so the next time that is on Monday, we'll pick on yield curves, and then we'll also look at now the fifth module. Okay. That's we will even see how to measure the Maclaurin duration and also the modified durations. That's the bond duration measurement. We'll also look at how to measure, for example, the credit ratings and also the convexity of bonds. Those are just some of the parameters of bonds that an investor should be looking at when they before invest. Sorry.
So we are closing the meeting now.
We'll that's in the next module. Or what were you suggesting?
No.
We have but before we close, I just wanted us to just provide a quick recap of everything we've talked about, just to enhance our understanding. And then next time, we'll go on measuring bond performance, and also we'll look at, I mean, not only bond performance in terms of its duration, convexity, and also the credit ratings of the corporations, for example, that issue such bonds. Okay.
That's okay.
Okay. Yes. We'll be in terms of duration. I said we'll look at the maculated duration and also the modified duration. Okay. So just to provide a quick recap of what we looked at over the period of our training, we started with looking at capital markets. We looked at the classifications and the various levels of trading in the capital markets and investments. We looked at the primary markets, for example, especially when a company wants to do an IPO, or when a corporation wants to issue corporate bonds, or when a government wants to issue treasury bonds. Okay, we said that, for example, we looked also at the different ways in which a company can raise capital, especially startups. They can either do an IPO, especially if it's a company that wants to transition from being a private to a public company. That's the very first time they want to transition, or they can do a direct placements where they go directly to the institutional or individual investors, such as venture capitalists, insurance funds, pension funds, mutual funds, things like that. And then also the last the last method, we also looked at how they can also do for example, a prospectus. Okay, we looked at an hypothetical startup of what their best capital raising method would be, and we said they would need to approach, for example, some institutional investors in a direct placement. We looked at even how to inform their IPO. I mean, what will be contained in their IPO, for example, in their prospectus. We said they'll need to define basically in detail for example, their missions, and their growth projections, their capital projections, their revenues, things like that. They can easily pitch to potential investors to lure such investors to invest in their or to buy their shares. Then we crossed over from primary markets to went to secondary markets. We said basically it's where a platform where there is the trading of securities, and basically buying of securities and selling of securities, buying by investors and also selling by the issuers of such securities. We looked at what mainly composes the secondary markets. We said the stock exchanges and also the players in the different players in a typical secondary market, for example, the intermediaries and also the issuers, government and corporations, and also even the institutional and the individual investors. After that, we looked at now how to, for example, how to hedge our risk. For example, when investors wants to, but before looking at how to hedge our risk, we looked at hedging our risk in terms of an investment, because those are some of even the other players or other commodities or instruments that can be traded in or can be dealt with in a secondary markets. Okay, derivatives, we looked at how people can invest in derivatives. We looked at futures, options, swaps. Okay, for example, how to do risk hedging. Okay, we said we looked at what derivatives are to be financial instruments that actually derive or their prices or value are pegged on the value of the asset that they are hedged against. For example, if it's an interest rate, or if it's a share, equity, things like that. We saw how even to create a mock exchange at a secondary market, for example, how you can, for example, track the shares of a company. We looked at an hypothetical movement or movement of a company that is listed at a stock exchange like Safaricom, how their share price can inform, for example, the trading behavior, the market perception, or what we call the investor perception, or investor say, investor perception of the company, and also inform the price of their shares that they can use for price discovery, and also for liquidity, and also capitulation or raising capital. Okay. What do we looked at? For example, how for example, what informs the interest rates that are set on, for example, some of the instruments that are traded at a secondary market. For example, bonds. We say that at a secondary market, they can trade in bonds, especially those issued by government and also corporations. We said what informs such interest rates on bonds. We said especially if it's for government issued bonds or treasury bonds, they usually risk rates. Therefore, the coupon or interest rates on them will be lower than corporate bonds that are usually pegged on the credit rating or the riskiness of the company issuing that bond. Okay. We looked at the different types of bonds. We looked at even the different distinctions or the differences in terms of their periods, their issuers, their corporates, their risk profiles and risk classes of each type of bond, both corporate, government, and also municipal bonds. We looked at an actual example of a case study where in 2014 Kenya issued its first Eurobond. It raised 2 billion, and the Eurobond was a 10-year Eurobond. The coupon rate was something 5%. And basically, for government bonds are usually for financing of infrastructure projects such as SGR or the Nairobi Expressway. Okay. After that, we looked at now the other kind of players. We were still on secondary markets. As we said, there are a whole lot of players in a secondary market, both issuers of such securities, bonds, and shares, and also investors in such bonds and shares, but also even the intermediaries that facilitate, for example, they or connect or link between these two parties. For example, we said that some of the biggest stock exchanges that host some of the biggest companies, the big five, the Nasdaq, the NYSE, and also even our own Nairobi Stock Exchange that hosts some of the listed companies in Kenya. But in addition to just the NSE, there can also be other players or other intermediaries, things like pension funds or brokerage firms, okay, that can also act as intermediaries in the secondary markets or the capital markets. We looked at our a typical portfolio, diversifications. Diversification. So if an investor wanted to invest in the secondary markets, how they present their mix of portfolio, for example, between assets or that in that case that is equity, or in terms of bond or debt that they wanted to invest in. For example, they'd like to invest. For example, they'd want to invest in the shares of companies from different backgrounds or industries to just diversify, and also just even diversify across different portfolio of instruments. For example, a little bit of equity, a little bit of debt, a little bit of derivatives, things like that. Okay. And then we looked at even the question you asked yesterday about investment analysis. We looked at the different the two types of main investor analysis, where an investor can either use fundamental analysis, basically looking at the various indicators, for example, the company or market indicators of that particular company, for example, the earnings of that company, the revenue of that company, other indicators and indices like their share price, their past share price, their market trends, their price per earnings ratio, their dividend ratio, things like that, those ratios. Therefore, an investor would analyze those and then come up with a proper investment strategy on which one, for example, on which particular pair of investments or diversification of portfolio to invest in, because analyzing that would even inform the investor which shares that are valued so that they can invest in, or which shares are overvalued so that they can take a short position and not invest too much on. In terms of secondary markets investors, we looked at now the two types of investors: institutional investors and also individual investors like you and I. Institutional investors can be, for example, insurance companies, even venture capitalists who invest in private equity funding, okay, mutual funds, pension funds, things like that, even banks and other brokerage firms who can both be intermediaries, but also some of the institutional. They can both be intermediaries in the financial secondary market and capital markets, but also to be the intermediaries. I mean, intermediaries and also institutional investors. Okay. After that, we looked at now the main role of capital markets in, for example, to a company. Okay, the role or the function or the importance of capital markets or trading in capital markets. I mean, what's the importance of a company issuing debt or a government issuing a Eurobond, for example, Kenya? It's basically, we said that it's basically how some companies raise their initial capital formation, okay? And also it even provides, for example, capital markets, both primary and secondary. We said that it provides a means for even somebody like me, okay, who here in Kenya, I would ordinarily not be able to invest, for example, in the shares of, let's say, a global company like Microsoft. Through capital markets and through secondary markets, okay, I can be able to access, for example, the New York Exchange and such trading platforms, and to be able to invest in such shares, okay. Then we looked at some of the trends, the emerging trends and emerging technologies around capital markets and both primary and secondary markets. We saw how AI is continuously informing how even investors perform their fundamental analysis, okay? How they are using AI, for example, to analyze market trends or to analyze, for example, companies' earnings and revenue, so that to inform them where to invest in. We also looked at how the blockchain technology and cryptocurrency in general is transforming the whole capital markets and investment strategies of investors. We looked at how even lately there has been increased awareness on even which companies or which shares to invest in, depending on what the company stands for or the values of that company in terms of, for example, on environmental protection, basically ESG, environmental, social, and governance. Okay, things like green funding, companies that are focused on green lending, green funding, and also climate action tend to have a very, very good public perception or investor confidence, and therefore that can inform an increase or their share price can increase. Therefore, we then went to the module 2, where we looked at now the financial instruments that can be traded at a typical capital markets. We looked at equities, stocks, shares, equities, which are basically stocks and shares, and how they work, basically how they can be traded in. We looked at the types of equities, the benefits of each, and also the disadvantages of each. Okay, we looked at how they can be traded, for example, in a typical stock exchange. We looked at how an investor in such types of equities can invest or can value and then invest in such shares and stocks through the two valuation methods that we just talked about. We then looked at now the fixed income securities, which are basically the bonds, that is both the corporate and also the government treasury bills and bonds. And then so now we also looked at now the derivatives. So there are some of the fixed income securities derivatives, both options, futures, and swaps, things like that. We looked at the different types, for example, of option, call option. We looked at an example of how to use each, or how an investor would use a call option to hedge themselves against risk and to profit, and also a put option, how an investor would use it to hedge himself or herself against risk. We also even looked at an example how futures can be used by, for example, airline companies or things like farmers or traders in commodities. Okay, can use futures contracts to lock in a future price, to hedge in against price fluctuations. But as we said, in the secondary markets and also in the primary markets, there isn't just investments in those main types of financial securities. There are additional securities and investment opportunities that investors in the secondary market especially can invest in. We said that some customers even involved in commodities, gold, oil, and also even in agricultural products. Okay, we even looked at some other investors prefer to invest in REITs, basically investing in real estate property without actually owning a property directly. We looked at how some people can even be private equity investors, basically being venture capitalists, looking at startups that they can fund, or also looking at private companies that they can buy out. By the way, that's how a practical example that I know. That's how, if you already looked it up, that's how Airbnb, this famous hotel and hospitality firm, hospitality app, that's how it was formed, basically, or it gained it was able to raise capital and go public. It was just a group of private equity firms. Okay. They received a very, very good amount of private equity funding before they went public, because investors saw the potential. Basically, private equity firms or private equity investors evaluate the potential of a firm. You can look at an upcoming startup or a firm or a private firm and then buy out. Like, let's say there is an upcoming startup in Kenya. Let's say Glovo. Glovo is already, let's say this let's say any Cocoa gas. Okay, let's say this Cocoa networks, Cocoa gas. Let's say it's a startup, it's upcoming in Kenya. You evaluate its potential in for example, even the market segment or the market perception that it possesses. Okay, and then as a private equity firm, you can decide to fund its startup, then or even buy it out. Okay, and then you can even also invest in the derivatives through, and also diversification. Diversification basically holding a mix of a little bit of each of the financial instruments that we just saw. After that, we looked at a practical example, how, for example, we looked at a practical example, how an investor can hold both or diversify both types of financial instruments, both the equity, that is stocks and shares, are also fixed income securities, that is the bonds and treasury bills, also derivatives, options and futures, and also even the commodities, rates, and also private equity funding. And then in our third module, we looked at in-depth equity markets, and even how valuation in such equity markets occur. We looked at now the components of equity markets, the stock exchanges, and also the different types of order types or trading mechanisms, basically, the market orders, the limit orders, and the stop loss orders. Okay. Basically, for example, my stop loss order where you sell so that you limit your losses. If, for example, the price of the stock you are buying drops below a certain level. Okay. We looked at some of the, for example, the role of these stock exchanges, for example, in their role in investments in capital markets, and basically in generally in the economy. We also looked at some of the biggest stock exchanges in the world, the New York Stock Exchange, the Nasdaq. The Nasdaq is National Association of Security Dealers and Automated Quotations, right? And then, as I told you, I'll give you some notes that are directly linked to even some of the sites that you can track. For example, the performance of some of these companies to be able to even do some of your own evaluation. Okay, both fundamental and technical analysis or evaluation. Okay, there are almost all the non-financial news websites, Financial Times, Bloomberg, Forbes, and all.
Yes. Can we forward the meeting to Monday? We clear it up on Monday. Hello. I don't know whether you can hear me. Hello. Hello. Can you hear me? Hello. Hello. Can you hear me? Ama hapa kuna shida network.
But now, just wasting his time.
Hello, can you hear me? Sorry about that. After that, then we looked at fixed income securities. You said we looked at that. We looked at now the equity market evaluation.
That's what I was asking. Can we do it on Monday?
Sure.
Yes, let's. But Monday we start early. Let's do it 9.
Okay.
And clear up.
I guess you are not available over the weekend, obviously.
No. Weekend.
It's fine. It's fine. So Monday, what time?
Monday we can start from 9.
From 9?
Yes,
sure,
that's okay with you.
Very much okay. In fact, I'd even propose we start at earlier, even maybe 7.
Yes, yeah, no, 7. No, 7 is too early.
No problem. Yeah. So basically, that has been our progress so far.
I'll be in there, so we can do it. It will be easier. Next week will be I'll be available anytime you. So we do, even if it's a power 4 or 5 hours. Then we do 2 more sessions, right?
Sure. Yeah.
That's okay with me.
Yeah, sure. So Monday 7.
No, not 7. 7 is too early. I said 9.
All right, 9 then. Okay, see you Monday at 9. Okay. But I hope our progress has been okay so far. Do you have any question up to the point that we've
actually, I'm very impressed by our progress.
Yes. Thank you very much, and you have a nice weekend ahead, and see you on Monday.
Okay, you too. Enjoy your weekend.
Okay.